Derek and Marcus. They're both 29. They work in the same industry, live in the same city, and each pull in $75,000 a year. After a few years of meal prepping instead of ordering out, driving the same car a little too long, and pretending they don't see targeted ads for vacations they can't afford, they've each saved up $65,000. Financially, they're basically twins. Temperamentally, not even close. Derek wants roots. He wants a door he can paint any color he likes, a kitchen he can renovate without asking permission, and a mortgage statement with his name on it. He's the guy who already knows what kind of grill he's going to buy someday, even though he doesn't own a backyard yet. Marcus wants options. He likes being able to leave a city on 6 weeks' notice if a better job, or just a better mood, shows up somewhere else. Committing to one zip code for the next 3 decades sounds to him like signing up for a very long book report he didn't choose. So they make different choices. Derek buys, Marcus rents and invests the difference. Let's spend the next 20 years watching what that decision actually costs and earns each of them. Same income, same savings, same starting line. Very different finish.
Derek finds a 2-bedroom condo he loves, $310,000. He puts down 20%, which is $62,000, leaving him with a $248,000 mortgage. Then come the closing costs: title fees, appraisal, inspection, loan origination, and a stack of paperwork he signs without fully reading, nodding along like he understands what escrow means. At roughly 3% of the purchase price, that's another $9,300. So before Derek has unpacked a single box, his $65,000 in savings is already gone. $62,000 down payment, $9,300 in closing costs, and he actually comes up about $2,300 short, which he puts on a 0% promotional credit card and pays off within the year. His safety net, for the moment, is basically zero. He locks in a 30-year fixed mortgage at 6.75%. Principal and interest come out to about $1,609 a month. Add $220 in property taxes, $95 in HOA fees, $110 in homeowners insurance, and $260 set aside monthly for maintenance, roughly 1% of the condo's value per year. And Derek's total monthly housing cost lands at about $2,294.
Marcus, meanwhile, rents a similar 1-bedroom plus den nearby for $1,750 a month. No property taxes, no HOA, no 2 a.m. phone calls about a leaking pipe. That's a text to the landlord and a mild inconvenience, not a financial event. That's an extra $544 a month compared to Derek. Marcus takes his full $65,000 and puts it into a low-cost stock index fund the same week he signs his lease. Every month after that, the $544 he isn't spending on homeownership costs also goes into the same account, on autopay, so he's never tempted to, just this once, skip it. For a while, this looks like the obviously smarter move. Lower monthly outlay, money compounding in the market, zero maintenance headaches, and a guy who can still describe his living situation as flexible at dinner parties. But, as with Derek, not all of Marcus's advantage is permanent, and it's worth being honest about why.
In Derek's first month, only about $195 of his $1,609 mortgage payment goes toward principal. The rest, $1,414, is interest. Add taxes, insurance, HOA, and maintenance, and out of his $2,294 total monthly cost, only $195 is building him anything he could call equity. The other $2,099 is simply the price of owning a home that month, no different financially than rent. This is the part people skip past. Marcus's $1,750 in rent builds zero equity. That part's true, and nobody's disputing it. But it's also true that Derek's interest, taxes, insurance, and HOA dues aren't building equity either. Calling one throwing money away and the other an investment is at best incomplete. Only that $195 a month is actually Derek's in the ownership sense. And that number will grow slowly over time as more of each payment shifts from interest to principal.
6 months in, Derek's dishwasher dies. He watches a 40-minute YouTube video titled Fix It Yourself, Save Hundreds, orders a $30 part, and 2 hours later calls an actual appliance repair guy who fixes it in 15 minutes for $210. Derek pays it out of his maintenance fund without much drama. This is exactly what the fund is for. But it's his first real lesson that homeownership bills don't ask for permission. Marcus's water heater also goes out around the same time, in his rental. He sends one text to his landlord. It's replaced within the week. Marcus's only cost is mild annoyance and 3 cold showers. Derek has made 36 payments. His mortgage balance has dropped from $248,000 to about $239,400, just under $8,600 of principal paid down. Assuming 3.5% annual appreciation, his condo is now worth roughly $343,600. That puts his home equity at about $104,200. Marcus's original $65,000, invested at an assumed 9% average annual return, has grown to roughly $84,200. His ongoing monthly contributions, that $544 buffer, though it's been shrinking slightly as rent rises, add another $23,000 or so once growth is included. His total portfolio, around $107,000. After 3 years, the two are within a few $1,000s of each other. Derek has a condo he can renovate however he wants. Marcus has a portfolio he can take with him to any city on Earth. Neither one is winning yet. Derek's principal and interest payment never changes for the life of the loan. That's the whole point of a fixed-rate mortgage. But his total cost of owning does change. Property taxes climb as his home's assessed value rises. Insurance premiums creep up almost every renewal. And as the building ages, the maintenance fund gets used more often, not less. New water heater, HOA special assessment for roof work, eventually a kitchen that starts looking dated compared to newer listings nearby. Marcus's rent, meanwhile, rises about 3.5% a year. $1,750 becomes $1,811, then $1,875, then higher still, year after year. His monthly investing advantage over Derek shrinks a little every single year, even as the portfolio itself keeps compounding, regardless of what he adds. This is the tension sitting at the center of the whole 20 years. Derek's housing cost gradually stabilizes relative to his rising income, while Marcus's rent keeps grinding upward indefinitely. But Marcus's upfront $65,000, left compounding in the market instead of locked into a down payment, is quietly doing a lot of heavy lifting in the background the whole time. At year 5, Derek gets a modest raise and refinances his mortgage down to 6.1% after rates ease slightly, dropping his principal and interest payment to about $1,510 a month. It costs him $3,000 in refinance fees, which he pays out of pocket rather than rolling into the loan, on the logic that he'll break even within about 2 years of lower payments. Marcus, that same year, gets offered a job in another city, the exact scenario he always pictured for himself. He gives 30 days notice on his lease, pays a small early termination fee, and moves. Derek, watching from his condo, briefly imagines what this would look like with a mortgage, an HOA board, and a garage full of tools, and decides not to think about it further.
In year 7, the stock market has a rough stretch, a correction that knocks Marcus's portfolio down by about 18% over several months. On paper, he loses tens of thousands of dollars almost overnight. It's uncomfortable. He does not sell. He keeps his automatic monthly contribution running exactly as scheduled, buying more shares at lower prices without really meaning to be strategic about it. It's just what the autopay does. Derek doesn't feel this at all in his day-to-day life. His mortgage payment doesn't care what the S&P 500 is doing. But his home's paper value dips too, in line with a broader regional slowdown. Appreciation for the year comes in flat instead of the usual 3.5%. Neither of them panics. Both, in their own way, just keep going.
Derek is 39. His condo, appreciation having resumed its normal pace, is worth roughly $437,000. His mortgage balance has fallen to about $208,000, partly from the extra pace of paying down principal at the lower refinanced rate. That's approximately $229,000 in home equity, more than 3.5 times his original down payment. Marcus's original $65,000 alone, at a 9% average annual return, would now be worth about $153,800 before counting a single dollar of his monthly contributions. Layer in 10 years of consistent monthly investing, including the dip in year 7 that he rode out instead of selling, and his total portfolio lands somewhere between $240,000 and $260,000, depending on exactly how the market behaved along the way. At the 10-year mark, the two are close enough that the winner depends heavily on assumptions: market returns, home appreciation, how disciplined Marcus stayed through both rent increases and a market dip, and how well Derek's building has held up structurally. Anyone who tells you confidently at year 10 which path is correct is guessing. By year 15, the picture starts to separate a bit more. Derek's home, now worth roughly $520,000, has a remaining mortgage balance of about $140,000, putting his equity near $380,000. His monthly housing cost, while higher than it started due to taxes and insurance, has grown much more slowly than the local rent market. His income has risen faster than his housing costs, giving him more breathing room in his budget than he had at 29. Marcus's rent, after 15 years of roughly 3.5% annual increases, is now around $2,930 a month. Still lower than what a comparable home purchase would cost him today, but a long way from the $1,750 he started at. His portfolio, benefiting from a decade and a half of compounding on both his original $65,000 and his monthly contributions, is now somewhere in the $420,000 to $460,000 range. Derek is 49. His mortgage is nearly paid off, about $52,000 remaining, on track to be fully owned within a few more years. His condo, after 2 decades of appreciation, is worth somewhere around $616,000. His home equity, roughly $564,000. His monthly housing cost, relative to his now much higher income, feels almost negligible compared to where he started. Marcus's portfolio, after 20 years of compounding on both his original $65,000 and 2 decades of monthly contributions, even as those contributions shrank in relative size against ever-rising rent, lands somewhere in the $520,000 to $600,000 range, again depending heavily on actual market performance versus the assumed average return. Put the two numbers side by side, and after 20 years, 2 guys who started with the exact same income and the exact same $65,000 end up in remarkably similar financial positions by 2 completely different roads. So who won? Honestly, neither one lost. And the reason isn't that renting and buying are secretly identical financial products, because they aren't. The reason is that both Derek and Marcus rewarded the same underlying habit for 20 straight years, consistently putting money to work instead of spending it. Derek's forced savings plan was his mortgage payment. Every month, whether he felt like it or not, a chunk of his paycheck got locked into an appreciating asset. Marcus's plan required actual, ongoing discipline, a monthly transfer he had to keep making, even as rent climbed, even during a market downturn, even when a cheaper apartment across town might have been tempting. The honest conclusion isn't buying wins or renting wins. Change the mortgage rate by a point, change the market's average return by a couple percent, change the city's rent growth or home appreciation, and this whole story tips one way or the other. What actually separated Derek and Marcus from someone who ends up broke at 49 wasn't the choice between a mortgage and a lease. It was that both of them, every single month for 20 years, did something with the money instead of letting it disappear.